What's up, everybody? Wednesday, June 30th, end of the month, end of the quarter, end of the half. First half is over. So, we got a slowdown in the fiscal flows. I think it's starting to be a little bit evident right now. I just went over the numbers today. The daily leading flows are now at the slowest, coming out at the slowest rate, or they're the smallest since beginning of January. Beginning of January was right before, I think we had the another stimulus hit right around that time, a little bit after that. But the flows are slowing down now, and the growth rate in the flows year over year. And you know, I mean, these year over year comparisons that I sometimes put out there, it's understandable that that gap is shrinking. Like when you compare the fiscal flows now to the fiscal flows at this time last year, because at this time last year, you know, we were still into the ramping up of the stimulus. So I'm not so sure that looking at that narrowing differential is so, you know, consequential or so meaningful. But the daily slowdown in the flows, what I'm seeing now, and this is really like the first time it's starting to show up in the data, and I think it's starting to look pretty evident. I mean, by that I mean it sort of looks like there's a trend developing here where, you know, it's slowing down. What does it mean it's slowing down? It means every day a little bit less money is getting pumped in. Now, you got to understand that we're still at historically very high levels in terms of fiscal support. I mean, if we were talking about these kind of numbers, you know, just 2 years ago, I mean, these numbers are still off the charts. So it might be, you know, really kind of a moot point to say, you know, there's a problem here. However, you got to understand that stocks are at all-time record highs, and we've had a huge rally off the pandemic lows based on, you know, that first stimulus and then the second stimulus and then the third stimulus, and now things are slowing down. Now, having said that, mid-July, we're going to see some more fiscal support in the form of these child tax credit payments, actual checks. Okay, but I think I went over the numbers. I think it's like $250 or $300 per child per month. That's still way less than what people were getting in unemployment benefits. By the way, almost all the states that decided to opt out of the program have now opted out. I mean, there's a few more states in the first week of July. You know, tomorrow's July anyway, July 1st, and then we'll get a few more states cutting the benefits. But now we're starting to see the impact of those cuts. And if you go back to my videos that I made, you know, back in May, I was saying, hey, be prepared when those states start cutting benefits. You know, you may not like what you see. And that also goes for those particular states. Now, I spoke about this the other day where supposedly right now the data is starting to show, and I haven't gone over this data, it was an article in a blog, Zero Hedge. It says that the states that cut the benefits, they're seeing people return back to work. But again, it's not so much the return to work, it's about the income. All right, if they're going back to work and they're earning less at jobs, which, I mean, ostensibly, you got to think that the reason they didn't go back to work was because the benefits were paying them more than their job was paying them. So if they go back to work at a lower monthly income, that's less disposable income. That's a reduced driver for the economy. So yeah, you might get more people going back to work, but at lower incomes. Anyway, we'll see. The important thing is, at least for me, the important thing is that these flows are slowing down. I mean, it looks pretty obvious to me now. It's not like a precipitous, you know, deceleration, like a really sharp deceleration, but it looks like it's developing into a trend now, whereas before, like last week and the week before, when it kind of looked like that was happening, but then, you know, you'd get a day where it looked like it was picking back up. Now it really looks like they're decelerating. So that could be a problem. All right, now somebody mentioned something, hey, you know, what about banks and bank credit? What if we get into a new credit cycle? And that's a good point. You know, and it's not a point that I overlooked or that I have not been thinking about. You know, clearly the economy can be sustained if there's a new credit cycle. But I think in order for a new credit cycle to happen, and let me just say that there are some signs in the banking data that loans are picking up. I mean, in some segments, like particularly in consumer loans, credit card and revolving credit. And that might be people, you know, just tapping into their credit cards to stay afloat. Auto loans have been on fire, but that could also be reflect just higher automobile prices, right? I mean, like a year ago, if the average price of a car was 35 grand and now it's 40 grand, yeah, loan volume is going to be that much higher. So I don't know how much that really reflects a robust sales, environment, or just the fact that prices went up. So you got consumer loans going up. Last week you had a pickup in real estate loans, but that was like the first little blip up in like 3 or 4 weeks. Commercial and industrial loans really contracting hard, still year over year down like 15%. Total amount outstanding, you know, way down as well. So I don't see any signs of a big new credit cycle boom, but you know, it's something to consider. If the government cuts back on its spending, or if spending slows, I mean, you do tend to see households tap more credit. I mean, it makes sense. It's logical that, you know, if you're not getting those checks, and if those checks are a form of financing for your living, you got to go get financing somewhere else if you can. But income is a factor too. All right. If incomes are going down now with the cutbacks in the fiscal support, you know, you need income to qualify for credit. So if incomes are falling, I don't know if that's the environment for another credit cycle. So anyway, you know, that is something that I've been thinking about, and something that could sustain the economy and a stock market rally. But for me, overall, it's the fact that these flows are slowing down. And by the way, very interesting, if you look at how gold is trading, if you look at how the dollar is trading, right? Gold's going down. And I'm kind of laughing at this because there was so much bullish talk leading up to the Basel III new rules. And I did a couple of videos on this. I did several videos on this, saying that, you know, all the bulls that I saw were these over-the-top gold bugs, you know, talking about how Basel III is going to be this monumentally bullish event for gold. And, you know, it's just been going straight down. But what I was going to say is that the peak in the daily spending flows, listen to what I'm saying, the peak in the daily fiscal flows coincided with the peak in gold, okay, back in early June, and it coincided with the bottom in the dollar index back in early June. Now, all this makes sense. If the flows are contracting, if the flows are decelerating, then it makes total sense to me that gold is going to be going down and the dollar is going to be going up. So these things align, which says to me, at least it shows me, or it gives me a little bit more evidence, a lot more evidence, I would say, that the contraction in flows, that's a real thing going on right now. And it's showing up in the behavior of some very important markets like foreign exchange and gold. Anyway, more on this in my daily reports and emails. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trading. See you tomorrow, July 1st. Bye.